Investment bonds allow you to invest without paying any capital gains tax so long as you satisfy the rules of the bonds. And there are two main ones that you need to look out for. The first is the 10-year rule. So basically, the 10-year rule says that so long as you leave the investments for 10 years as a minimum, then you don't pay any capital gains tax on the gains made on your money through that period, which is a huge saving. The beauty of the 10-year rule is that it starts from the time that the first contribution is made to the bond. So that means that you can invest today and then next year, the year after that, and even in 9 years' time, as soon as you pass that 10-year period, all capital gains are received essentially tax-free. So it's not a matter of each contribution needs to sit there for 10 years. It's just simply that the 10 years from the time that you made the first contribution, and then it's all CGT free. The second main rule of bonds is this 125% rule, which says that you can only contribute each year up to 125% of the amount contributed in the previous year. Sounds a little bit confusing, but essentially it's sort of simple. So basically in the first year, if you were to contribute $100 to the bond, in the second year, the amount that you're able to contribute and get all the tax concessions is limited to $125. In the next year, if you do contribute in the second year $125, in the third year, you can contribute up to 125% of the $125. So essentially, in this case, $156. And then it grows and grows from there. The thing that you need to look out for, though, with this 125% rule is that if there is a year where you don't make any contributions, then the following year and all future years, you're essentially going to be limited to zero because 125% of zero is still zero.